Let's talk about the biggest lies investors hear about hard money loans. These myths cost people deals, and I'm here to shut them down. So myth number one, hard money loans are too expensive. First, I'm going to debunk this myth right out of the gate by saying that hard money loans facilitate transactions. There's an opportunity cost, and I can't tell you how many borrowers have come to me in the last 10 years saying, my bank failed to close, I need to close in a week or two, or I lose the deal. I lose the deal could mean I lose my deposit, so there's a significant amount of money on the table, money at risk that the borrower is going to lose if they don't close their hard money loan. And then there's just those transactions that are coming to me because they need to close quickly, that can't be done with a bank, and they need to go hard money. So you could be getting into a deal where there's $100,000, $200,000 in profit, where you don't even care how much it costs in terms of a loan or in terms of bringing in a partner and how much equity you're gonna split. There's so much room for profit. You just need to get the deal done. And hard money loans facilitate transactions where speed means everything. And ultimately, when you look at loans, you should be looking at, like anything else, time value of money. You should be looking at your investment timeline. You should be looking at the best execution for the strategy. And hard money loans aren't meant to be 30-year fixed loans for investors to buy and hold forever. Those are for banks. Those are for our DSCR programs that offer low rates and allow borrowers to cash flow. These loans are usually backed by investor money. They're backed by Wall Street. These loans are fast-moving 12-month loans, interest-only loans that are meant to fund residential transition properties, the fix and flips. The ground-up construction is another example of a product that would work perfectly because they're fast-moving. These borrowers, you as an investor, are looking to be in the deal for 2, 3 to 6, 8 months max. Ultimately, when you look at the costs of doing business in that time frame, you don't really care so much about interest rate. You don't care. You want to just get into the deal. So there are certain ways to look at hard money. There are certain ways to look at investments in general. They're kind of similar in that you're always looking at the numbers, you're managing the cash flow, and ultimately you're looking at your cost of borrowing, and you're looking at aligning that with the time frame of the transaction. So 12 months, quick fix and flips, borrowers that are looking to be in transactions for 3 to 6 months, they're coming in saying, I don't even care about the interest rate. A 12% interest rate, which is higher than our highest here at ABL, is going to be a point of interest a month. So if I'm going to be out on a project for 4 months, well, that's 4 points of interest. That's not too dissimilar from a bank. If you annualize it at the end of the day, you're paying 4 months of interest. That's all you're paying. You don't care about amortization. You don't care about low rates. You care about your cost of borrowing. So at the end of the day, what is it going to cost you to close a transaction becomes more important. So where hard money lenders tend to make their money is on origination fees. It's points up front. So you got to be careful about those when you're going into a hard money loan and looking at programs. We have 0-point programs here at ABL, which is unique in the industry because we have enough volume to know that we have some borrowers that are going to be out 8 to 10 months. Some projects take longer, some projects aren't as long. So we tend to blend out our profitability through a barbell approach that gives borrowers that are fast the benefit of a low-cost closing. It gives them the speed to get through a project. You have other borrowers who are new that can't get through it so fast that we offer programs for, and we offer lower interest rates and higher point programs for folks that are going to be out, 8 to 12 months with our loan. So you have to focus on cost of borrowing always. Now, let's talk about it. We're closing the loan in 2 weeks. The bank's 45 to 60 days, right? So let's say the bank goes in and closes. You're already 2 months late to the game. You've already gotten through the renovation with a hard money loan. Now you're starting the renovation with a bank 2 months in. You're probably talking about an extra 3 to 4 months of pain, either through the draw process or through the closing to do business with the bank. If you were able to get the sale to, or the purchase to have happened to begin with, and then you're again dealing with this elongated process, you're expending more time and money, you may miss the market on the other side because it took too long. Bottom line is hard money lending facilitates transactions. When you look at the actual cost of borrowing, upfront costs, you talk about interest costs, and you put that into the transaction and you spread it out over the time that you're actually out you realize interest rate doesn't matter as much. The cost of borrowing is the cost of doing business. In fact, it's cheaper than bringing in a partner for 50% of the deal because you need to get it done cash or hard money, and you went partner. Partner's expensive. Partner's 50% of the profits. Hard money's fixed. So there's another example of going out to an investor and bringing cash to the table to avoid high interest rates when you just gave up 50% of the deal when you could have had a fixed interest rate of sub 12 with a hard money lender. Myth number 2. Hard money loans are for desperate borrowers only. That can't be further from the truth. I would say that on average, my borrowers pull between a 710 and a 760 credit score all day long. Our minimum is 660. I think generally the industry is 620 to 660. Quite honestly, as long as you have experience in the particular project scope and size that we're talking about, we'll overlook credit and make exceptions. But at the end of the day, our borrowers are credit worthy. My borrowers deal with all different types of banks, credit unions when they need to, when the project makes sense. They're very liquid. They attract a lot of investor capital. So at the end of the day, my borrowers are well-heeled. They have great credit. They're financially, stable and have the liquidity to do business with conventional sources, but choose hard money for the speed and the scalability of our funds in terms of growing their portfolio. You can't compete. We close loans in 2 weeks. Banks are 45 to 60 days. A lot of my borrowers can get through flips in that amount of time. Never mind, wait for a bank to close and mistime the market. So at the end of the day, hard money is absolutely for all different types of borrowers. I think if you look specifically, our average credit score for my borrower pool is easily over 710, and I don't see that changing. Myth number 3, hard money lenders don't care about the deal, the underwriting. They just care about the collateral value, and as long as that's there, they'll lend against it. There's segments of this hard money lending space, which we know and love, that will lend to anyone for any reason as long as the value of the property in excess of the loan. And some hard money lenders out there will get a deal on a Friday, and on a Monday they'll be ready to close with very little due diligence because they know you, they have a different relationship with you or whatever. The fact of the matter is that we're going to analyze it, we're going to structure it, we're going to make sure that it's a win-win. There's a profitability factor that we'll look at when it comes to different scenarios. In a fix and flip, as an example, we'll want to make sure that there's a certain dollar profit in smaller deals, a percentage profit in larger deals, and we'll look at LTVs and other factors. We're not just going to go in and say, okay, the value of the house is 100 grand. We're going to make a loan for 70 grand. The borrower has no liquidity. The property's worth 100 grand. Let's just close it 2 days from now. It doesn't really work like that. We want to make sure that the borrower is going to be able to exit it. We don't want to get into a situation where we're literally looking to foreclose to get repaid. No one wants that. I mean, ultimately in the end, why I love hard money lending is because I'm helping borrowers facilitate transactions and grow their portfolio. And I've helped borrowers go from 0 to 50 million in real estate, or probably more in total portfolio value. The benefit is, unlike consumer lending, I'm able to do several loans with a borrower a year, a month. And so I want these borrowers to come back. I want them to trust me as a partner in underwriting their transactions and know that we're going to be there to grow their portfolio, to close when they need us to close. And part of that is going to be our upfront due diligence. I mean, we really spend time looking at the project, making sure that the scope of the reno matches what we see in terms of the need of the house in that case. And ultimately, the result is a certain value that supports our loan, or it could be a debt service coverage ratio that supports the takeout loan on a multifamily. One way or another, we care about the deal. We care about our borrowers. We're looking at the deal in a way that not only we see the result for us in closing a loan with a new borrower or with a repeat borrower, but that we see the borrower exiting confidently, whether it be a sale or refi. And we're going to be right alongside the borrower to make sure that the numbers work for everybody, and that ultimately our loan is a win-win for both us and the borrower. Myth number 4, you can't grow a portfolio using hard money. I've been talking about it throughout this video. I've had borrowers go from 0, and I mean 0, to over 50 million in assets using hard money. Now, hard money loans are not for every deal. We've talked about this throughout the videos in my channel. You're going to have banks, you're going to have different types of lenders for different things. With lenders like us, we have 2 programs that complete the BRRRR strategy, which in my mind is the best way to grow a portfolio. And that's to buy, renovate, rent, refi, rinse, and repeat. Our bridge programs, 12-month loans, and then for quick flips, hard money loans in the traditional sense. hands. You're gonna buy it, you're gonna renovate it, and through the renovation and buying it right, of course, you're gonna create enough value where you can either refi your equity out or hopefully even cash out beyond that. One way or the other, you're going to refi out some of the equity that you've created through the fix and flip and using our bridge loan program, and you're going to be in a position to refi into a lower 30-year fixed rate through our DSCR program and put the deal to bed, as I like to say, and let it cash flow and let that be one of many properties in your portfolio that you've bought, renovated, and refied into permanent debt using the DSCR program. And ultimately, that's how it's done. That's how people use us, right? They're coming in, they're using those fast flip bridge loan programs to get into the deals, to buy it right, and ultimately through the stabilization, putting in the right tenant, hitting the rents that they need, gives us the DSCR, the debt service coverage ratio we need to support a higher loan, the bridge loan going in, and ultimately these borrowers are taking that equity that they're cashing out and they're deploying it into more assets, coming back to me to fund more bridge fix and flips with as little as 10% down, a little as 7.5% of the total project costs down. So when you look at it like that, the little capital you need to get into a fix and flip with us, the fact that with the right deals, you'll be able to cash out, take the cash as if you were to have sold it, but keep the portfolio building with cash flow and deploy that cash through the refi and deploy it into more assets and ultimately continue to build your portfolio from there. And I hope some of my borrowers will like this video. I can tell you there's been several, but growing your portfolio from 0 to 25, 50 million is definitely not unheard of. And I'm hoping you'll hear a few testimonials on this channel from borrowers that have used me for exactly that. So don't believe everything you hear. Hard money lenders aren't scary. They're not dangerous. We facilitate transactions. We help borrowers grow their portfolios. Hard money is without a doubt a stigmatized term, and we try to change that in this industry to private lending, but it is what it is. It's a term that I'm embracing because to me, it really means flexibility. To me, it means common sense underwriting. It means that we get to look at the deal, look at the whole picture and say the borrower's experience outweighs credit or the scope of the rehab or whatever it may be to be able to get deals done and to give the borrower the confidence that we're going to execute and close every single time. So I hope this video helps debunk some of the myths, some of the stigma that surrounds hard money, because I know it does. I've been dealing with it for over a decade now. And yet at the same time, I'm watching borrowers come back to me day in and day out to close loans when they're bankable, when they have enough cash, quite honestly, to close the deal in cash. They're constantly using my money to facilitate transactions and to grow their portfolio. And that could be in asset-based lending's bridge program. That could be through our DSCR program, which offers low 30-year fixed rates. One way or another, investors, active investors, investors with perfect credit, with great liquidity, with excellent experience, bankable investors come to hard money lenders day in and day out to close deals. My name is Mike Chadwick. I've been in the hard money space for over a decade. I look forward to your comments. Please don't be shy. If you have a deal that you want to discuss, reach out to me. It takes 10, 15 minutes for me to generate a term sheet and to give you a sense of what program fits best, what program within programs fits best, because we have low fixed rates on the DSCR side over here, like I said, and we have the fast moving bridge loan programs over here. So thanks again for watching, and I look forward to seeing you on the next one.